The first week of July 2025 opened with a defining statement from the global investment landscape. Institutional capital is not just returning to crypto, it's accelerating. According to data released by CoinShares on Monday, digital asset investment products saw a net inflow of $1.04 billion. Between June 30th and July 6th, this marks the 12th consecutive week of positive capital movement into crypto funds, bringing the 3-month cumulative total to $18 billion. The numbers aren't just big, they're breaking records. This steady flow of capital has now pushed assets under management across all crypto investment products to an all-time high of $188 billion, shattering the previous peak from late 2021. But beyond the headline figures lies a deeper story, one about shifting investor sentiment, regional contrasts, and a market maturing under the pressure of real money and real accountability. 12 straight weeks of inflows isn't just a fluke, it's a sign of conviction. It signals that institutions, hedge funds, sovereign wealth portfolios, and high net worth investors are making strategic allocations to digital assets. These aren't just speculative moves driven by hype. These are portfolio reallocations rooted in long-term macroeconomic themes, inflation hedging, diversification from traditional equities, and exposure to the digital asset infrastructure that is now rapidly integrating with global finance. The $1.04 billion inflow last week is particularly impressive given the low volatility trading range Bitcoin maintained between $105,000 and $110,000. This was not a momentum-driven surge. It was a fundamental one. Geographically, the United States continues to dominate the global inflow picture, with $1.02 billion of the total $1.04 billion in net capital coming from American investors. This is a clear signal that U.S.-based funds, ETFs, institutional custodians are winning the trust of investors and capturing their capital. The dominance of the U.S. can be attributed to two converging forces. Regulatory clarity is improving. With active legislative pushes such as the Genius Act and the Clarity Act, product maturity with a wide range of accessible, scoped Bitcoin and Ethereum spot ETFs that offer liquidity, security, and transparency, Germany and Switzerland also recorded positive flows of $38.5 million and $33.7 million, respectively, showing that the institutional appetite is broader than just the U.S. Meanwhile, outflows in Brazil, $9.7 million, Sweden, $19.2 million, and Canada, $29.3 million, hint at regional risk-off sentiment or simple portfolio rebalancing, possibly. Due to local macro or regulatory concerns, Bitcoin funds remained the core beneficiary of capital last week, absorbing $790 million of inflows. Yet, this number represents a slowdown compared to the prior 3 weeks, when BTC funds averaged $1.5 billion per week. Why the pullback? One reason is simple. Bitcoin is approaching its all-time high, with prices sitting just 3% below the critical $112,000 level. As BTC hovers in this key resistance zone, investors are becoming more measured and strategic, awaiting either a confirmed breakout or a healthy correction. But make no mistake, Bitcoin still leads the way. Bitcoin dominance BTCD continues to hold above 65%, asserting its position as crypto's reserve asset, particularly in uncertain macroeconomic conditions. While BTC inflows may have slowed slightly, Ethereum is accelerating. ETH funds attracted $226.40 million in fresh capital last week, and more importantly, have outperformed BTC funds in terms of growth rate. Over the past 11 weeks, ETH funds have posted an average weekly growth of 1.6%, double the 0.8% growth rate of BTC funds. This divergence is not a coincidence, it's structural. Ethereum is not just a digital asset. It's a platform of programmable economy that powers stablecoins, NFTs, DeFi, and tokenized real-world assets. Institutional interest in Ethereum is largely being driven by successful rollouts of ETH'S. ETFs. Massive stablecoin growth on the Ethereum network, scalability upgrades, such as Pectra, which are lowering gas fees and improving transaction throughput, the rise of tokenized treasuries and RWAs, most of which operate on her. As institutional investors begin to differentiate between store of value assets like BTC and infrastructure platforms like ETH, we may continue to see more balanced fund inflows over time beyond Bitcoin and Ethereum. Altcoins are slowly regaining institutional attention. While still a small slice of the total pie, several names saw meaningful inflows. Solana Sol, $21.60 million. Ripple XRP, $10.60 million. Sui, $1.60 million. Solana's performance is particularly noteworthy. With high throughput and increasingly robust developer activity, Solana is positioning itself as the fast lane of the crypto ecosystem, especially for DeFi and NFT-related use cases. Its ETF approval probability has also been raised by Bloomberg analysts to 95%, boosting investor confidence. XRP, benefiting from ongoing legal clarity after its favorable ruling in 2023, continues to draw capital from those seeking exposure. 2. Compliant payment networks. And although Sui is still early in its journey, its ability to attract institutional flows suggests it may be one of the standout L1s of the next cycle. A critical takeaway from these inflow numbers is the distinction between structural and speculative capital. What we're seeing now is not the manic buying of retail investors in 2017 or 2021. This is methodical capital rotation from traditional finance into digital assets. Asset managers and institutional players are allocating 1% to 5% of portfolios to crypto, often through regulated ETFs or institutional custody solutions. These flows are slower but stickier, forming the foundation for long-term market cap stability. They're also agnostic to weekend volatility. Funds don't chase pumps, they reallocate based on risk models, quarterly earnings, and macro conditions. This makes 12 weeks of inflows. It's far more valuable than 1 week of parabolic price action. This sustained capital inflow points to a broader narrative. Crypto is maturing. From custody to compliance, from regulation to real-world use cases, we are entering a phase where digital assets are becoming indispensable infrastructure for the global economy. Central banks are researching CBDCs, corporations are tokenizing assets on Ethereum, and governments are drafting laws that treat crypto as an asset class, not an anomaly. Investors are responding accordingly. The fact that crypto funds have now hit $188 billion in OM is not just a number. It's a vote of confidence in the future of this industry. And as we edge closer to Bitcoin's potential breakout and Ethereum's scaling revolution, this is just the beginning. $1.04 billion flowed into crypto funds last week. It's 12th week of consecutive inflows. $18 billion in total net inflows over the last 3 months. Total OM for crypto funds now at all-time high. $188. BILLION dominated inflows with $1.02 billion. Germany and Switzerland also saw gains. BTC funds still strong, but growth is slowing near HAPS funds gaining momentum. With superior OM growth rate, altcoins like Sol XRP and Sui are beginning to attract institutional flows. If 2021 was the year of speculation, 2025 is shaping up to be the year of sustained structural liquidity. With another $1 billion entering crypto funds in the first week of July and nearly $20 billion over the past 90 days, the writing is on the wall. Institutions are here, and they are not just dipping toes, they're stepping in. The next chapter won't be written by meme coins or hype cycles. It will be defined by capital allocation, legal frameworks, and scalable infrastructure. And week by week, the capital is flowing in to build exactly that.